The panelists for this session include Mr. Simon Olsen, partner at Equity Capital Markets Group, Deloitte, Mr. Salamun Bekele, senior legal advisor at the Ethiopian Capital Market Authority, and Mr. Victor Nkiiri, senior specialist capital markets at FSD Africa. The session will be moderated by Ms. Hanna T, Teshome, senior legal advisor at the Ethiopian Capital Market Authority. Please welcome our panelists and Ms. Hanna T to the stage. Thank you.
Of Justice. So today's session actually is about IPO preparedness, IPO preparation strategies for issuers and service providers. I think before we kind of get into this conversation, I just want to ask one of our market practitioners, in particular, how significant this particular directive is, because as we know, the capital markets is an ecosystem, and the regulatory framework is a key component of that ecosystem. So I was hoping perhaps Victor Nkiiri could tell us a little bit about how significant this particular moment is. What is the importance of a regulatory framework in the context of capital markets, this particular regulatory framework, and then perhaps you could touch a little bit about really what is an IPO, what does it mean, and just give us some general context for the conversation we're about to have.
Thank you, Hannah. Those are two packed questions. But let me first say congratulations to the Ethiopia Capital Markets Authority for the two directives that have been issued out. I'm well aware about the amount of work that has been put behind this, and yeah, there's been a lot of sleepless nights to put this through. So congratulations again through your leadership, Hannah, and the whole team. Of course, we just want to appreciate all of us, the work that the regulator has done. So to your question, I think let me use the word effective regulatory frameworks, because I put the adjective because sometimes if regulation is not used in the right way, it can become a hindrance. So effective regulatory frameworks in the capital markets can have 4 positive effects. And the first is to the investors themselves. So they create a playfield that brings fairness and transparency to the market. So clear rules ensure that market participants are able to be treated fairly across the whole market and have access to information. And I mean ready access to information across all participants. The second thing is risk mitigations. These frameworks on regulation help to reduce risks by setting up standards. And by these standards are disclosures in the markets. That is, the companies and the players are mandated to make certain disclosures. And then secondly, it's financial reporting. So you have standards that are set out on financial reporting, the structure and the dates, there are deadlines on when to do your financial reports. So these help reduce risks in the market. And thirdly is corporate governance. So having a corporate governance structure really helps reduce the risk in the market, because you have tried to mitigate this through the board in these companies and also through the management. The third to the investors is confidence building. So well-regulated markets are able to build confidence to the investors, where some of the investors in the market feel that they are professionals in that particular market who understand capital markets and are watching over it, and therefore they don't feel the pressure that they have to have a capital markets understanding or capacity for that. The second thing that this does is integrity. It helps build integrity in the market by preventing fraud and manipulation. So enforceable rules, and the key word here is enforceable. Enforceable rules, they deter fraud, they deter manipulation, and they help to safeguard the integrity of the market. Then the second thing under integrity is they create a level playing field for the market, whereby having same rules prevent unfair advantages in the market. And by unfair advantages, I mean aspects like front running in the market, aspects like conflict of interest disclosures. So that's what creates a level playing field in the market. And the third one under integrity is having efficient allocation of capital. So naturally, when you have a well-regulated market, capital will first be allocated on the most productive aspects of the economy. And that helps boost the economy because capital will first focus on what is most productive in that economy. The third issue is economic development. And I'll, of course, start with job creation. So what effective regulation actually does is create a vibrant capital markets. And what vibrant capital markets bring about is expansion of businesses. They are able to expand, and as all these businesses are able to expand because of capital, then they're able to employ more people. So you have good quality job creations that are created through these companies. The second one under economic development is financial inclusion. So as these businesses, the business are able to grow and expand, what normally happens is that they're able to access capital across different industries. That creates financial inclusion. And especially for the financial markets companies. This is both the techs that are doing fintechs and also the finance companies like insurances that are able to expand their branches even to rural areas. They provide financial inclusion. The last, of course, is international competition, whereby you attract foreign direct investments that come in because foreign investors are now confident about the standards that are being observed in that market. You're observing international standards and are able to attract money. So that is just to answer your first question. Now, on the second question, and I think that word has been used here a lot today, the word IPO. So what does it really mean? It means initial public offer. And when you talk about an IPO, what are we offering to the public? And why is it an initial offer? Because this is the first sale of a stock to the public by a company or an organization. It normally has two objectives when it's being sold to the public. The first objective is to raise additional capital for that company. Either it wants to expand or has a certain purpose or has a certain use of proceeds of the funds that will be raised. Now, this, if it is raising additional capital, the use of this money will be stated in a document popularly known as an information memorandum that will be circulated to the public for them to read and to understand why the capital is being raised. The second objective of an initial public offer is the exit of an existing shareholder. For example, that can be the government itself. Now, the two differences between additional capital is that new shares will have to be issued when it is additional capital that needs to be raised for the company. They need to issue new shares. If it is just the exit of an existing shareholder, then it will be the shares of that particular shareholder that will be sold to the public. Now, there are four characteristics of an IPO, initial public offer. The first is that it will always have an open and a close date, when the offer is being opened to the public and when it closes. The second is that it will have a price indicated for that particular offer. And it will have a stated price, either in local currency or in foreign currency. It will have a specific price for it. The third is that it will have an allotment date. By allotment means that there is a specific day when the board and the management of that company will sit down and allot the shares after they have been applied for by the public. This is after it closes. The fourth is that there's a refund date. In case it is oversubscribed, and I know yesterday we used Menti to raise the questions, and we asked 4 questions. Will it be subscribed, undersubscribed, oversubscribed? So if it is oversubscribed, that means there will be some refund that will be given out. So a refund date is given. The 5th is what we call the listing date. And now, that is another term I've introduced, and I'll explain what listing means. The word listing means that a company is able to officially make its shares available for trading in a stock exchange. So once you finish your public offering, then you can go now to what is called listing, and that means that your shares can now be traded on an exchange. So listing, you can also have companies that can come to market. They don't want to do an IPO, an initial public offer, and they simply just want to list. Why? Is because they neither want to raise the capital and are neither pressured to exit any particular shareholder, but have the objective of ensuring that the current shareholders of that company can sell their shares in a marketplace, and other people can buy it. So that is what is called a listing by introduction, or making your shares publicly available for trading at a stock exchange. But what happens if the company that did the initial public offer comes again to the market and wants to raise capital? It is now, we drop the word initial, and we just call it a public offer. So we drop the word initial because you've already come the first time. So if Ethio Tel comes, say, next year or the year after next, and does another public offer, it will not be called an IPO. It will just be called a public offer, and we lose the word initial. I hope that answers the question.
No,
Hanna.
that's wonderful. I think now we all know the importance of the word initial. But this directive covers public offers, so both the initial and subsequent offers. And I think, Victor, you've very nicely laid out that this directive actually follows international standards and the importance of having this well-regulated market. So with that, perhaps Solomon, as one of the drafters of this directive, this directive, we know, governs the process of public offering, including initial public offerings. And so perhaps you could tell us a little bit about just some of the general requirements. We understand there's a registration requirement. We understand that there's a requirement for prospectus. What does it look like? And then perhaps tell us some of the new things that it's included, requirement of a transaction advisor. You could tell us perhaps a little bit about the role of a transaction advisor in the process of a public offering.
Thank you, Hanna, and good morning, everybody. So Hanna and I and others were working on drafting this public offer directive. It took us a while, but finally it is here. And congrats, Hanna and other team members. So, you know, we had capital market activities before the passing of the proclamation. So we have this market at least for the last 30 years. Unfortunately, the market was not properly regulated. Because of that, we have seen a lot of fraud and mismanagement, and the investors' money being disappearing. So we can, you know, when we start drafting this directive, what we started from was, of course, the proclamation itself, because we derive our authority from the proclamation. But we also studied the problem that was in the country before the passing of the proclamation. So we identified what the problem was in the market. So what we identified was that there was no proper regulation of conduct before the issuance, during the issuance, or afterwards. So this directive, what this directive does is, have set a proper regulation of issuers conduct before the issuance, during the issuance, and after the issuance. What does that mean is, as Hanna was mentioning earlier, any issuer of a security, before the company can issue its securities to the public, it has to be registered with the authority. And the requirement for the registration statement is, application for registration statement includes one main aspect, which is the prospectus. So the prospectus is the place where the company sets all, provides all necessary or material information that will make an investor, that will assist an investor to make an informed decision. So this is one new factor that's coming into picture. The other thing is regulation of advertisement. So I just want to make a short sentences on this one. Advertisement before, what the practice of advertisement before was very, very dismal. There was no proper regulation of advertisement. So anybody can say anything as long as they think that helps them to sell their securities. So from now on, those advertisement be properly regulated. We regulate the content. We regulate how and when the advertisement would be transmitted. The other thing is, we want trusted advisors to help the issuer during the issuance. So the other new introduction is then the introduction of professionals that are going to assist the issuers during the preparation of the necessary documents. And the last thing that we're, that's coming with this directive is, ongoing disclosure requirements. So we know through the process of the offering, the disclosure requirement is there, and for the secondary market, the disclosure that is going to be required is, disclosure through ongoing disclosure requirements. So, as Hanna was saying, there are transaction advisors that are going to be involved in this process. The main function of a transaction advisor is to assist the issuer to comply properly with the requirements of the law. Simon was saying yesterday, today about the job of the transaction advisor. Yesterday we heard from Rina and Tedros about the role of the transaction advisor. But I would like to come, I don't want to say, double down and state what the role of the transaction advisor is. But I would like to say one thing about trust. We all heard about trust in the market. Capital market, we all heard that capital market depends on trust. What does it mean? What are we trusting? Is the trust about making profit? The trust is about not making profit, or the trust is about information. So this presupposes two things. First is there is a provision of information. There is a requirement for the issuers to provide information. The second is, the quality of the information that is being provided. So there is a mechanism for assuring quality of the information that is being provided. One is proper review of the information that's provided by the authority. The second main part for main mechanism for assuring quality is requiring professionals to make the preparation of all the documents that are needed to be included in this registration statement. And not only require the preparation by professionals, independent professionals, but also, place a responsibility on all parties that are involved in this preparation, including the professionals. So that's why we require a transaction advisor, and the main function of the transaction advisor is to advise the issuer and prepare the offering documents according to the law. So to add a little bit of practical example in this process, we were doing the Ethio Telecom offering. From that process, we learned four things. The first thing that we learned from this process was the resolve. Resolve on the part of the government to walk the talk. We sat around 11 months ago, we sat at the PMO's office, the regulator, ECMA, led by the then Director General, Dr. Brook, Hanna, and me. On the other side sat Ethio Telecom. And Ambassador Girma was the mediator. So, you know, at that time, the public offer directive was just a draft. So Ethio Telecom, you know, if we're strictly speaking about the law, that was not even the law of the land. But we pushed for Ethio Telecom to go and respect this process. The government decided that's the route that we want to take, they want to take. So they want to lead by example. So the groundwork was established then. So they wanted to go with this process. So we learned, one, the resolve of the government, and second, our authorities' resolve. Even without the proper regulatory framework, we pushed for the respect of the law, and it happened. Then the second thing that we learned was that Ethio Telecom process became a testing ground, a live testing ground. Simon was leading the other side as a transaction advisor. We were the scientists. The Ethio Telecom was the guinea pig. So we tested our directive. We, you know, before that, we never had the opportunity to see, you know, we followed the international practice, the ISO principles, all those things. But we were not sure whether all those things will be able to work in our context. So Ethio Telecom process assured us, at a minimum, this is a working process, this is a working draft for the Ethiopian context. So it was a testing, live testing process for us. The other thing that we learned from this process was we tested our capacity. Simon and his group, flying from London, Kenya, South Africa, with all their nice suits and everything. First time they gave us a draft, it was 200-something pages of nothing. Simon, are you following us? Okay, let me be a little bit fair. It had something, some content, but most of the pages were blank, just with titles of the sections. That's where we started. And you see the end result. You know, Hanna and I were leading the review process, and probably everyone in the Capital Market Authority participated in this process. We learned a lot. We improved the directive. We pushed back when we need to push back. We accommodated when we had to accommodate. So the second lesson that we learned from this process was, you know, our capacity, and also, you know, what we are writing would be really applicable to our context. The third, still the positive thing that we learned from this process is, you know, this is, you know, it's not a lesson, but this is the first properly regulated offering in this country. This is the first divestiture of a company or privatization through the capital market. So that was a good lesson for us on what to do, and what not to do. In the testing that we're going to receive from the other side, you know, the issuers are always testing our limits. So we saw where that limit ends. The fourth, but unfortunate lesson that we learned from this process, and also the other process that we have, or engagement that we have from with stakeholders, in other jurisdictions, normally the private sectors drive change. Unfortunately, what we saw from this process, basically not only from the Ethio Telecom process, but also from our engagement with the public for the last 2.5 years, was it is the government that's driving, In the private sector, that's lagging. That was truly an unfortunate experience that we have. And I hope this will change, and this has to change very soon. Thank you.
Wow. That was great, Solomon. I think I'll just carry on with the live testing process that you mentioned, because I think a couple of other people have also mentioned that phrase, I think in a different way, for other types of products. So in terms of live testing, and Simon, you were part of our live testing, Deloitte being the transaction advisor on the Ethio Telecom transaction. But perhaps not to talk about necessarily Ethio Telecom from your perspective, as a licensed service provider. Maybe we could take a step back. Tell us more what you do as a transaction advisor. What steps do you take to make the issuer ready to IPO? And perhaps also, if you could also educate other future service providers, and not to educate your competition going forward, but what is a service provider's job in the context of an IPO?
Perfect, thank you, Hanna. And Solomon, I'm pleased to hear you appreciate my tailor and my suit, so thank you. I think before I answer your question, actually, one thing I would like to do is reiterate on behalf of myself, Teddy, and the entire team at Deloitte, congratulations to the ECMA and everybody else on publication of the directive. It really is a significant milestone in the capital markets for the reasons that have already been enumerated. And having worked with you, Hanna, you, Solomon, and the rest of the team extensively for the last year, I know how much work it has been for you, so congratulations. In terms of the role of a transaction advisor, I would actually see it as very broadly twofold. The first is to work with the company to assess, is IPO the right thing to do in the first place? And having assessed that to be yes, then working with you on how to successfully make the IPO happen. The second role is around, okay, having established we want to do it, how practically are we going to make the IPO happen? Detailed planning of how we're going to do it. What are the relevant rules and regulations? What could be difficult? What could be complicated? What may be a long lead time? What stakeholders do we need to engage with? What advisors do we need to engage? But building with the company the whole program of how do we get from the start right the way through to the finish, and then navigating the company through that. And that very much includes ensuring we have compliance with all the relevant laws and regulations, the directive in particular, ensuring that we meet the requirements of the ECMA. And for us as transaction advisor, it's actually our job to make sure that the ECMA is happy with the final product, to discuss any potential issues with the ECMA as we go along, and to ensure ultimately that everything that requires submission and approval is submitted and approved, and therefore ultimately that the IPO gets approved and can happen on time. In terms of some of the lessons that we've learned from the first exercise we did, and then more broadly, I think, for the companies considering IPO now in the country, there are a number of things I'd draw out. I think the first is make sure you answer that why IPO question up front, and make sure that you get all your shareholders and stakeholders aligned early on what that is. Now, that's not an Ethiopian specific context, I'd say that anywhere, but as we go through the early stages of capital markets here, making sure you as a board with your shareholders and any other stakeholders are aligned on what you want to do is hugely important. The second thing I think we've learned a lot about is getting the business into the right corporate structure to be able to IPO. So that means having the right corporate entity with the right level of ordinary shares to be able to IPO those onto the market is important. For example, with a state-owned enterprise like Ethio Tel, we had to convert it into a share company. And linked to that, when you do the IPO, there are a number of approvals that you'll require from various regulators. There are also potentially a number of no objection letters you may well require from people like lenders or financiers to the business, and these can take some time to get, especially as we introduce precedent and new concepts into the market. So proper planning for that is important. I think this will get better known as we go through more transactions, but the requirements for a prospectus and indeed the requirements for the broader filings that need to be made under the registration statement should be planned out very early. Now we have the benefit for future transactions of being able to see the precedent we had from Ethio Telecom, but the exact detail and nuances are going to vary deal by deal. So it's important for us as transaction advisor and the companies to work through exactly what's going to be required and plan that through. There was mention earlier of stale dates and financial statements. Very important to recognise that you have financial statements that are in the right gap, that are audited by a proper auditor and that audit opinion is unqualified, and then are within the stale dates set out in the directive, and we can happily work through companies with that. And then I would say also building the capacity of the company, as I said earlier, has to happen early and has to be an ongoing process throughout. I think the last learning, and something that potential issuers in the room should just be wary of, or aware of rather, is still, we talked today a lot about firsts. Right? A lot of the firsts have now been done, hopefully. We've had a lot of fun being the guinea pig as we've gone through the Ethio Tel transaction, so a lot of the firsts are established. But I would say over the next year or so, as further issuers come to the market, we are going to encounter more firsts. We're going to have businesses from different sectors that will have firsts. We're going to have different scenarios that will have firsts. So my message would be work with your transaction advisor to try and understand what these may be. It enables us to engage early with the ECMA where that's required. But also there's an element of just, you have to expect the unexpected and just build in a bit of contingency. Because as we go through a lot of things for the first time, it's not always possible to predict exactly what would happen. I think in particular as it comes to some of the interaction with existing laws and regulations and the capital markets as they unfold.
Thank you for that, Simon. I think one of the things we can really take away from what everyone has said is the notion of disclosure and transparency. That is a foundational principle, it's a guiding principle of the public markets. Just want to highlight that point. We are running short of time, so what I'd like to do is actually put some questions out to the public. Please, any questions specifically on the directive? Even though Solomon is on stage, please could you save that for tomorrow, because there will be a detailed session where you can ask every single question you want on that. But if you have any questions specifically on the topic, which we've kind of veered off a little bit, on IPO preparation strategies for both issuers and service providers, please let me open the floor for questions right now. If you have a mic to go around, just, where's the mic? Yeah. Somebody, I'll take 3 questions, and there's one behind. And then somebody from the back, there's somebody all the way in the back, I see a question. In the meantime, I'll just ask perhaps Victor, Simon, just to just maybe talk a little bit about some of the success factors in IPOs. Like, what are the key factors that actually improve the IPO process? Maybe we can chat on that while the mic is going out there. If you want to just say something briefly, Victor.
Okay. I think once the market gets ready for the initial public offers, it would be very good to have, and I know we have corporate governance specialists in this room. I can see Rose Lumumba there. But having corporate governance codes would be something that would be very critical for the market. And just having a roadmap to that corporate governance would be very well, so that the whole market understands what that actually means. And I know that is something very heavy on the directives that have just been issued. The second thing would be board training and development. This is the board of directors, training them and ensuring that they are upskilled, their skills are well capacitated, they understand what IPO requirements are, or coming to the market, what those requirements are according to the directives. They understand what their role is for financial oversight in those companies, and they also understand what the corporate ethics mean and how critical those are. So those would be some of, and probably the third one would be regulatory market reviews. This is just conducting governance audits in the markets, especially post-IPO, and just seeing how, just getting a report, more of a governance audit and seeing where you are. It's more of checking the temperature in the market, asking yourself the question, what have we done well, and what can we improve on? Yeah.
Simon, you want to add on to that?
Yeah, I think just to probably give some practical thoughts for companies. An IPO for any business is a major undertaking, and an IPO has many different work streams, it's multifaceted, and there are a lot of dependencies. And no two IPOs are the same. So what I would say for any company is you must spend time up front planning. So like any major project undertaking, the first thing you must do is plan. So establish what work streams are required, when does the work need to be done, and then critically you need to move on to the next phase, which say, okay, if I know what needs to be done and when, then who is going to do it, and build enough resource to do that project, be that resource internal resource, contractors you bring in, or bringing in firms like us to help. Quite likely a combination of all of those things. The last thing I'd say is, once the project is up and running and you've done that plan, you need to put in place proper project governance, again, as you would do for any major project. So you need a proper steerco with your steering committee, with the key stakeholders, and then you need proper work stream structures to ensure that people deliver things on time, and therefore the overall can be achieved on time.
Thank you for that. So can we take a couple of questions from the audience? Where's that? Okay.
Thank you. My name is Isaac Taka Nebere. I'm from Agar Microfinance Share Company. My question goes to Mr. Simon. Mr. Victory mentioned that initial public offering is a new share to raise capital so that the company will expand its operation. My question is, Mr. Simon, as a transaction advisor to Ethio Telecom, does this 10% share that is issued in a primary market qualify as initial public offering? Because we have understood from prospectus, 100 billion paid up capital is presumed as initial capital. 10% of that capital, 100 million, are going to be issued in a primary market. In my opinion, since they are already owned shares by the Ethiopian investment holding, they have to be issued in a secondary market, which is in Ethiopian context, ECX, that are going to be opened. Because Ethio Telecom is not just raising the capital, as it is already shared, already sold capital held by Ethiopian investment company. So what is, as a transaction advisor, what's your opinion on this regard? Thank you very much.
The next one, can we take one from the back, please?
Thank you. My name is Brahanu Desta from British Council Ethiopia office. My question is, now the directive is out, so henceforth, what will be the status of our private banks? I think I've seen from the media that most of the shareholders decide to raise capital. So as we speak, or as of these days, they are raising capital. So who is going to regulate that? What is the plan from your side? Thank you.
Thank you. I am Fasil Tasso from Unity University. My questions are two brief questions. The first question, the participation of private sector is too lagging. It's only the driving force is from the public sector. When you process the formulate the laws, Ato Solomon said, so why is that? Why private sector is lagging? My second question, as far as preparation of this regulation is concerned, Victor reported the essential points of due date, maturity dates are very relevant for investors. From this perspective, how did both from the source side as to look at the temperature of the business, and from the use sides to look at the relevant of timely records, how did the regulation addresses this problem? Essentially, those are very important part of procedures to process business. In other words, how do you address, we have two currencies per dollar, and also two recording technologies are called from Hamle 1st to Sani Salasa of the budgetary of Ethiopia versus July 8 to July 7 of the budgetary of the templates world. Thank you.
Okay, let's start with these three questions, and if we have time, we'll carry on. First question from Ato Brhanu. So, pardon me, first question is for you, Simon. It's about actually a point that Victor addressed, and maybe Victor will also repeat that point again, but it is about what does an IPO mean and the various definitions that we have. How does the 10% sale of Ethio Telecom shares qualify to be considered an IPO if it's about raising capital from the company? So just maybe before you answer that question, Victor will repeat the various points that you were making about nomenclature, so maybe to highlight that point. And then the second question is, as the directive is out, what would be the status of our private banks? What is the plan? So perhaps Solomon, you can talk about that point. And then Fasil just asked quite a few questions, but I think the crux of his comments really is about how do you reflect the temperature of the business. So perhaps it's about what kind of information does the business need to tell about itself in an offering document. How does the regulation address timeliness of the info? So perhaps on the prospectus, Simon, you could talk about that. But in terms of the timeliness of the info, Solomon, maybe you could talk about what kind of information is required on an ongoing basis, perhaps timely disclosure points, and also the last point he mentioned also is about the financial years, that there's Sene Salasa and there's December 31st for the rest of the world. You know, what is a financial year? How do we generally expect it reflected via the disclosures? So start with you, Victor, please, if you could just start with the nomenclature.
Yes, thank you, Hanna. But before I start, I think there's a word that was introduced, transaction advisor. And I just want to clarify. So there are several parties that are involved in an IPO, and maybe Tilahun should conduct a masterclass for this. Who are all the parties who are involved? And Tilahun and ESX, I'm giving you that role. So what does a transaction advisor mean? And the regulator, ECMA, cannot be a transaction advisor. And a transaction advisor has to be someone independent who's appointed by the issuer themselves. The issuer will go through their own procurement process to appoint a transaction advisor. A transaction advisor will be, or you can use the name financial advisor, will be someone in the financial markets, either an investment bank or someone actually who has been involved in issuance. For example, Deloitte, who was here on stage, can also be a transaction advisor. But remember, all these are parties who, again, are regulated by the Ethiopia Capital Markets Authority. So they have to fall under that particular regulation. So I just wanted to clarify that so that the regulator is not seen as a transaction advisor of Ethio, so that there's no that confusion. So back to explaining IPO, the initial public offer. And as I said, the word initial simply means that this is the first time that a company is offering its stock to the public. That means 120 million Ethiopians can now purchase that share at a specific price, and it can be accessed by every citizen in this country. Anybody can buy that share and is welcomed to apply to purchase that particular share. And that's what it means by initial public offer. As I said, it has two objectives. The first objective can be to raise additional capital. That means that means that company or that organization has issued new shares. New shares, that means it dilutes all the shareholdings of the other shares. That means they will own a lesser percent because new shares have been issued. The money that will be paid by the public to purchase these shares, that money will actually go to the company, and it will have certain objectives, either expansion or purchase of capital equipment or something that is stated in the prospectus or what is called the information memorandum. The second objective will be the exit of a shareholder. For example, in Ethio is the exit of the government themselves, and these proceeds that will be paid for the purchase of that share will actually go to the existing shareholder. That means the shareholder will reduce their shareholding and will reduce their influence into this particular organization.
Thank you. Do you want to add to that?
Yeah, I think just to make sure it's absolutely clear, the Ethio deal is very definitely an IPO, and I want everyone to take that away, otherwise we'll be in a lot of trouble from this panel. So it is very much an IPO, and I think just to echo what Victor said, IPO literally means the first offering to the public of those shares onto the stock exchange. It doesn't matter whether they are new shares issued by the company for growth purposes and growth capital, or whether they are existing shares issued by the shareholder for exit purposes. And as has been said, Ethio was 100% secondary, but we have seen IPOs be all different things. It doesn't matter where the shares come from. It is the fact that it is the initial public offering onto a stock market. I mean, it's actually a bit of a technical but interesting point around the majority of IPOs are not actually offers to the full public. So whilst for large state-owned enterprises and certain other very large organisations, you will go to the effort of doing a sale literally to 120 million people. For most companies, that is a lot of expense and actually very complicated. A lot of IPOs are actually to a much more restricted audience, generally limited to institutional shareholders, high net worth individuals. So whilst it's not technically an issue to the full public, people still call it an IPO because it is your initial offer.
Yes. Okay, the question that was raised to me was the status of currently publicly held companies like the banks. So, we're aware of the fact that there was a lot of companies who have already offered their securities, and by virtue of having a large number of shareholders, they are considered as publicly held companies. And also there is offering that's going on at the current time. So the directive requires every pre-existing securities to be registered with the authority. Also, any security sale that's being conducted currently has to be registered too. But we realized through the process of the Ethio Telecom and also other factors that this process takes time. So we placed a transitional provision whereby we give every company a year to comply with these requirements. So the banks and the other companies that have already issued their securities will be required to complete their security registration with the Ethiopian Capital Market Authority within 1 year of the passing of this directive. So you have 1 year to register your current securities and the securities that you're providing at this time. You know, because we are aware of the time that takes to be prepared, you know, Simon was saying it's going to take, you know, normally it takes this amount of time to get prepared. We are aware of that from the get-go. So we started engaging with the stakeholders, including the banks, the insurance companies, around 2.5 years ago. That's why I say the private sector is lagging behind. Still, we're still getting the question that whether they will be required to, to register or comply with the law that's going to come up. So, the reason for this lagging behind is, because they are comfortable. One of the questions that was raised is why are the private sector lagging? So what we identified is because they are comfortable at this time. Because we were aware of this, when we engaged with them, we started providing samples, 2 slides. We prepared 2 slides. One about the history of Kodak and Fuji, why, the repercussion that you can get by not, by resisting change. And the other one is the Blockbuster and Netflix. We started engaging with the, because we identified that everybody is comfortable with where they are, and they're not willing to change. We started giving them examples, real-life examples, what consequences of not going with the change will entail. Unfortunately, most did not heed, some have. So hopefully, they will wake up, and the private sector will be leading this capital market. Earlier, one of our panelists was saying, even about the capacity building and other activities, it should not have been the job of the authority to do these things. But because we're not seeing anybody from the private sector getting up and doing this job, we have to do it, because this is one of the mandates that we are given to develop the market. So that's one thing. Regarding the timeliness of information disclosure, there are 2 things that is in place in this directive. We have 2 requirements. One is periodic disclosure requirement, where every company will be required semi-annually to provide information to the public, to the authority, and the exchange or the market. The other is current information disclosure. That should be whenever there is a material information that happened in a company. It could be the resignation of a board of director. It could be the resignation of CEO or CFO. Material information that will affect the price of the share. We require those information to be shared with the public and the authority within 24 hours. Thus, we make sure there is a timely disclosure of material events. Thank you.
Thank you very much, Solomon. Thank you all for listening to us. Thank you, Simon. Thank you, Victor. I think we need to wrap it up here. But again, there will be a session tomorrow for more detailed discussion on the directive. So I really encourage issuers and future service providers to attend that session, which will be with Aganet and Solomon in Amharic. Okay, thank you.